Mehvish, what's the house view on how to trade this environment? I know we've spoken before. You're saying stay defensive, perhaps move into cash. What is the strategy now?
So if we look at our sentiment indicator, which is a proprietary sort of global multi-asset version of VIX, what we've seen is heightened volatility across all asset classes since the beginning of this year. And unfortunately, there was some respite in the second half throughout July and August, and we've seen all asset classes with their extreme levels of volatility, whether we look at currencies, whether we look at fixed income, whether we look at equities, whatever regional equity index we look at. So that to us is a warning signal that it is not a good time to be owning financial assets. The unfortunate thing is when we think about multi-asset portfolios is we typically tend to use a variety of asset classes for diversification purposes. And the issue that we're faced with is what do we own for diversification? At the moment, we cannot look at commodities as such. We cannot look at your typical fixed income. And that is why cash is king. We are still very defensive. I think one has to take a view, is this a bear market? In which case, are you strategically looking to play bear market rallies tactically? But really, you have to take a view that the trend is downwards and play that trend downwards.
You know, it's really hard to find any bull calls out there at the moment as well. Mehvish, the next data point that investors are going to be looking out for globally is the CPI print out of the United States, unlikely to tilt the register for the Fed or perhaps spark some kind of Fed pivot that the markets have been looking out for. It does appear the Fed is pretty much locked and loaded for another 75 basis point hike. Would you agree?
Yes, I would agree. I actually think if you play out the scenario analysis that could occur after the US CPI print, whatever occurs, the Fed is not going to pivot. I mean, at most, the market could hope for some sort of mediation in the inflation numbers, but the absolute numbers are so high and inflation is so well entrenched in the economy that the Fed is likely to stick to its dot plots. And I think that is very negative for markets. Also because you have the ongoing Russia and Ukraine crisis, which has gone on for much longer than what was expected. You have the lingering impact of COVID still in terms of supply chain pressures. You also have the sudden OPEC production cuts from last week. And on top of all of that, you have the sort of crisis in the UK.